Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
I want aggressive cuts now!
The reality is far more sinister.
You'll do as I say!
We'll see.
Chair Kevin Warsh, The Impact and Rate Path for 2026. This article was written by Hawk Invest. Summary. Kevin Warsh's appointment as Fed chair is unlikely to deliver the aggressive rate cuts many expect, given the FOMC's divided stance. Despite political pressure and leadership change, the Fed's power to lower long-term rates remains constrained by persistent inflation and high government debt. Market impact from the new chair may be muted, as expectations are likely priced in and long-term yields remain sticky despite recent cuts. Potential reforms, such as increased transparency or Operation Twist, may have limited effect, with bond vigilantes and structural factors capping the Fed's influence. President Trump has finally announced who he has appointed to replace Jerome Powell as chairman of the Federal Reserve. This was quite an event after months of public criticism whereby President Trump suggested that Jerome Powell was too late with interest rate cuts. This open criticism and the demands for interest rate cuts set up concerns about the independence of the Federal Reserve and the expectations that President Trump would select a new Fed chair who would be more dovish. Now that Kevin Warsh has been nominated to take over in May, if confirmed, let's take a closer look at how this change will factor into the decisions made by the Federal Open Market Committee, or FOMC, the rate path for 2026, and the potential market impact. Kevin Warsh served as a member of the Board of Governors of the Federal Reserve System from 2006 to 2011. His studies focused on economics and statistics at Stanford University, and then he went to Harvard Law School, receiving a law degree in 1995. In addition, he studied economics and capital markets at the Massachusetts Institute of Technology's Sloan School of Management. He worked at Morgan Stanley and served as special assistant to President George W. Bush. Kevin Warsh has called for regime change at the Federal Reserve and criticized the Fed for being stuck with models from 1978 and for a lack of credibility due to changing narratives. Kevin Warsh is 55 years old and married to billionaire Jane Lauder, heiress and granddaughter of Estee Lauder, E.L. Kevin Warsh is not viewed as being the most dovish candidate of all the potential picks that President Trump was considering. Therefore, I believe President Trump selected Kevin Warsh because of his views on mission creep at the Federal Reserve, as well as his desire to reform it and restore credibility. To give more insight into Kevin Warsh and his views, here are a couple of quotes from his past speeches. The conduct of monetary policy in recent years has been deeply flawed. A robust reform agenda requires more rigorous review of recent policy choices and significant changes in the Fed's tools, strategies, communications, and governance. Two major obstacles must be overcome: groupthink within the Academic Economics Guild and the reluctance of central bankers to cede their new power. Financial markets and the Treasury market are telling us almost nothing about the state of the economy because central banks are influencing those prices with every word, with every nuanced speech from every Reserve Bank president, Warsh said in the 2015 interview on CNBC. We would be better off if markets were setting prices instead of taking their lead from a bunch of government officials 7 years into a U.S. economic recovery. There have been some changes and other events with the FOMC lately. The most recent significant news regarding the Federal Reserve is that Jerome Powell is being criminally investigated by the Department of Justice for his testimony and involvement regarding renovations at the historic Federal Reserve building. The cost of these renovations has surged to around $2.5 billion, which appears excessive to some observers. However, this investigation appears to be an unprecedented event, and I believe it further raises concerns about whether the Federal Reserve can operate independently. Doubts about the Fed's independence could increase the chances of the market testing a new Fed chair. Stephen Miran is viewed as dovish, and he was appointed by President Trump in September 2025 after Adriana Kukla stepped down early. Lisa Cook is a current member of the Federal Reserve Board of Governors with a term that is set to expire on January 31, 2038. However, President Trump has been attempting to remove her from the board over allegations regarding mortgage issues, and the situation remains uncertain since she is legally challenging her attempted removal. The Supreme Court heard oral arguments for this case in January 2026. Lisa Cook appears to be more dovish and in favor of rate cuts, so I am not convinced that replacing her will tilt the balance for lower rates at the Fed. Current FOMC members. The Federal Open Market Committee, or FOMC, consists of 19 members, 7 Fed board governors, and 12 regional Fed bank presidents, but only 12 are voting members. The FOMC typically meets 8 times per year. Here is a summary of FOMC members and where they stand on policy, which shows why the Fed is divided. The hawks are generally more concerned about inflation and therefore prefer a more restrictive monetary policy. The members who are considered to be more hawkish include Michelle Bowman, Jeffrey Schmid, Alberto Mussolem, and Susan Collins. The doves typically prioritize maximum employment and growth and are therefore more inclined to be in favor of less restrictive monetary policies. The members who are often considered to be more dovish include Austin Goolsbee, Christopher Waller, John Williams, Lisa Cook, and Stephen Miran. Centrists are viewed as being generally neutral and try to balance the Fed's dual mandate of price stability and maximum employment. Some of the members who appear to be centrists include Jerome Powell, Philip Jefferson, and Michael Barr. The impact of the new Fed chair. The appointment of a new Fed chair has been made into a much bigger deal than it might have been, because President Trump has been a highly vocal critic of Jerome Powell and his policies. President Trump has even gone as far as to say that he has wanted to fire Jerome Powell, and he has repeatedly said that he wants lower interest rates. I believe all of this has fueled big expectations for the new Fed chair, and perhaps even big expectations from some investors that major interest rate cuts are coming in 2026. However, I believe it is important to remember that even though being Fed chair is influential, it still represents just one vote. Furthermore, I believe that the FOMC is divided, and that it will remain divided, perhaps even more so if the hawks dig in their heels when the new Fed chair replaces Jerome Powell in May 2026. It is worth pointing out that even though Jerome Powell's term as chairman ends in May 2026, his underlying term as a member of the Board of Governors does not end until January 2028. That means he could stay on and continue to have his one vote, just as he did as chairman. While I believe the new Fed chair will work to lower interest rates, I think expectations might be too high in terms of where interest rates are likely to go in 2026 and beyond. However, another area of impact could be potential reforms that could come with a new Fed chair. There have been many calls for major reforms at the Federal Reserve, which come from various political and economic perspectives, including from Kevin Warsh. The requests for reforms at the Federal Reserve typically include demands for more accountability and transparency regarding monetary policy, as well as structure and governance issues at the Fed. Some proposed changes include subjecting the Federal Reserve banks to the Freedom of Information Act, FOIA, making the Fed's decisions on stress tests and regulatory actions more transparent. Some Fed critics want to see a more rules-based monetary policy, such as using the Taylor rule, to reduce uncertainty and political influence, and some critics want the Fed to controlling inflation as its only mandate, rather than having a dual mandate, which currently includes maximum employment when it comes to the labor market. There have also been calls for limits on the Fed's ability to purchase financial assets and to limit emergency lending powers, which allowed the Fed to pick winners and losers during financial crises in the past. The potential rate path for 2026 and beyond. Of course, the Fed has to balance between two mandates, which are keeping inflation in check with a 2% target, and the other mandate, the labor market. Other considerations for setting policy include fiscal policy, ensuring financial stability, and global economic conditions. The Fed is in a tough spot because inflation is now running at nearly 3%, which is well above the Fed's target of 2%. However, the labor market has weakened considerably in the past few months. I think the labor market could deteriorate rapidly from here, with AI giving companies an option to increase layoffs and forgo new hires. However, if the job market continues to deteriorate, this should ease inflation pressures throughout 2026 and potentially give the Fed more room to ease than what is currently expected by some Fed members. To know where Fed expectations are, it makes sense to look at the dot plot. The dot plot chart below shows where interest rates are projected to be in 2026 and in the coming years. Each dot on the chart represents each member's interest rate projection for that year. The dot plot data shows that rates are expected to nudge down just slightly in the next couple of years. Potential market impact on the markets, and why I view the Fed's powers as relatively limited. I believe the market impact of the new Fed chair might be limited because it is widely expected and therefore possibly mostly priced into the market already. It could even turn out to be a sell-the-news event when Jerome Powell is replaced in May, as market expectations for what the Fed chair can do might already be too high. I believe bond vigilantes are less likely to accept Fed rate cuts when it comes to long-term yields, because global bond yields have been rising. Just look at Japan. Plus, the U.S. government debt situation was considerably better during the last major rate-cutting cycle, and inflation was lower during the last rate-cutting cycle as well. I believe too many investors have expectations for huge changes in interest rates after Jerome Powell's term as Fed chair ends. And as mentioned before, he could stay on and still have the same voting power that he had before. Also, rate cuts typically have more impact on the short-term rates and 2-year bonds, and less so on 10-year bonds, which are what mortgage rates are typically based on. In order to get the all-important housing market going again, much lower mortgage rates are needed. But the 10-year bond yield remains sticky and has not moved much despite recent rate cuts. For all these reasons, I believe the Fed's power to lower rates will be limited. If you look at the iShares 20-year Treasury Bond ETF, TLT, you can see that it has remained stuck in a trading range for the past couple of years, despite the recent rate cuts, and despite expectations for more rate cuts in 2026. This shows that the Fed has not been able to have a significant impact on long-term rates, and I expect that to continue to be the case because inflation remains elevated and the massive U.S. government debt load continues to grow, which is putting pressure on the market for higher yields. Look at the chart for TLT below to see the lack of progress on lowering long-term rates. In what I view as another sign that longer-term rates will remain elevated, even despite Fed rate cuts, the Mortgage Bankers Association has announced its projections for mortgage rates, and it believes that interest rates will remain over 6% through 2026. As shown below, the real estate firm Redfin is also predicting only a slight improvement in mortgage rates and expects mortgage rates to remain above 6% for 2026. To me, this suggests that not much relief is coming for the housing market when it comes to affordability with mortgage rates, and that does not bode well for the economy overall, especially with the job market losing strength and potentially putting more pressure on the housing market. Operation Twist in 2026? There is an option that the Federal Reserve could use to try to lower long-term rates, which it has used in the past. The Fed's Operation Twist is a monetary policy tactic that is used to lower long-term interest rates and stimulate the economy without expanding the balance sheet. To perform Operation Twist, the Fed sells short-term Treasury securities and it buys an equal amount of long-term Treasury securities. The name Operation Twist comes from the intended impact on the yield curve. By selling short-term securities, the yields on these bonds rise, and by buying long-term bonds, the yields typically fall, resulting in a twist effect on the yield curve. The difference between Operation Twist and quantitative easing, or QE, is that Operation Twist is balance sheet neutral, as it simply shifts the Fed's balance sheet from short-term securities to long-term securities. If Operation Twist is enacted again, as it was in 1961, 2011, and 2012, it could lower mortgage rates and make car loans and corporate financing less expensive, thereby boosting the economy. There are some drawbacks with Operation Twist, as some critics believe the impact is too small, with studies on this showing it only reduced rates by about 20 basis points, or 0.20%. The impact of Operation Twist in the 1960s can be seen in the chart below. Some critics suggest this is like pushing on a string, and it could create losses for the Fed in the future and eventually become a burden to the U.S. taxpayer. It can raise short-term rates, which could offset some benefits for the economy. Did the Fed flatten the yield curve in the 1960s? Will the market test the new Fed chair? When a new Fed chair takes over, the market often is viewed as wanting to test the person in this role to establish credibility and set boundaries. There are a number of examples of this occurring in the past, and this includes the way the market responds to communications from the new Fed chair to something more drastic, such as a market crash that could be a test. Jerome Powell was considered to be tested during his first couple of years over political independence, because even back then, President Trump wanted lower rates, and that created market concerns that the Fed would lower rates just because the president demanded it, which could cause the US dollar to decline in value. However, Jerome Powell did not bow to this pressure and instead insisted that the Fed was data dependent. When he cut rates in 2019, he said it was due to the trade war and slowing global economic data. The market might already be poised to test the new Fed chair because we have already seen a big drop in the US dollar. And this could be over concerns about Fed independence and whether rates will be lowered simply because of pressure from the White House. The market was also viewed as testing Jerome Powell's resolve when it sold off aggressively as he appeared to be ignoring the slowdown in global growth. This became an issue in October 2018 when Mr. Powell said that interest rates were still a long way from neutral, which implied more rate hikes were coming, and the market reacted by plunging about 20%. Powell seemed to have received the message from the market, because in January 2019, he famously pivoted by saying the Fed would be patient and flexible before implementing rate hikes, and he dropped the suggestions that the Fed was on autopilot when it comes to raising rates. Alan Greenspan was also viewed as being tested by the market almost immediately after he took the Fed chair position. At that time, President Bush wanted lower interest rates, but inflation was an issue, and the market appeared to have doubts about whether Greenspan would stay tough on inflation. However, bond prices dropped and yields surged right after he took office, which implied that the market did not trust that he would be tough on inflation. But he passed the test because within 1 month of taking office, he convinced the Fed board to raise the discount rate. With inflation still well above the Fed's target of 2%, I wonder if the market will test the new Fed chair similarly, and this could mean higher yields. Greenspan was also tested by the markets during the '87 crash. The market plunged by about 22% in a single day, and Greenspan responded by flooding the banking system with cash and lowering interest rates. In summary, I believe the new Fed chair, Kevin Warsh, if confirmed, will have some impact on the Fed in terms of potential reforms, but probably not as much as the market might be hoping in terms of interest rates, especially if Jerome Powell stays as a voting member of the Fed. If Jerome Powell leaves the Fed, it will give President Trump another potential chance to appoint a more dovish member, and that could tilt the balance at the Fed. If not, the Federal Reserve is likely.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.